On Hot Picks today, we are taking a look at some specialized U.S. real estate investment trusts. Our guest focuses on hospitality and gambling REITs. He's particularly interested in hotel REITs these days. He says they are trading at a discount amid fears over consumer spending in a choppy economy. We're joined by Jay Kornreich, Vice President of Equity Research covering REITs at Wedbush. Jay, thanks very much indeed for joining us.
Thanks so much for having me on.
Just on the hotel REITs, investors have been generally avoiding them?
Yeah, absolutely. So, within the hotel REIT space, there's no long-term leases like you'll find in other asset classes. And so very connected to what's happening in consumer sentiment, fears in terms of where the economy could be going. And so, relative to where these stocks were trading at the beginning of the year, really meaningful discounts in terms of EBITDA valuations. And so there's been a lot of caution. One name that we really like right now is Ryman Hospitality, ticker RHP.
Okay.
Sorry, go ahead.
I was going to cut you off there. I'm sorry. It's a hotel REIT, and it does a lot of group booking, and that booking, the groups tend to reserve a long time in advance.
Yeah, absolutely. So the portfolio really caters towards large group bookings. Their average hotels have 1,000 to 2,000 rooms. And so catering to the group customer, it's a customer that really books on average a year and a half in advance. They have a robust out of room spend. And with that forward-looking bookings, it's a much more defensive approach to playing the hotel sector. There's much more cash flow stability and a read through into how revenue will be performing. And relative to the more transient oriented REITs, which are catering towards leisure transient and business transient customers, we're seeing a lot more optimism, not only in the defensiveness of Ryman, but also in how forward-looking bookings are going, which makes us confident in stock.
Though we do hear that some American convention business could be under threat because academics, for example, from other countries are reluctant to travel to the U.S. Could that be a threat to the business?
So there is certainly some concern in terms of what we call in the year, for the year group customer. Those are groups that book more last minute, that book and travel within the year. But as Ryman has commented in terms of the forward-looking bookings, still very strong. And just one interesting anecdote, that after the administration put in the reciprocal tariffs in March, forward-looking bookings year over year for March were down 50% relative to the concerns like what you were saying. In April, that rebounded to only down 8%. And we think it's only gotten stronger since May and back to traditional standards in its level. And so, based on that and the commentary we're hearing from the company, it's a lot of domestic groups that are really the large customer base of this company. And so certainly less exposed to some of the international inbound demand, again, relative to some of the other hotel REITs.
Your next idea is involved in the gambling industry, VICI, and they have some massive properties in Las Vegas, for example.
Yes, Vici, it's one of the two gaming REITs, as we call them. They own the real estate housing, some of the largest casinos, such as MGM, Caesars casinos, including the Venetian as well. They traffic about half their business in Las Vegas, half around the country. And what's interesting about this company is that when you think back to 2020, when the pandemic first hit, and even casinos were closed, you would think that this sector would have been one of the worst performing in the REIT business. In the end, at the end of 2020, it was actually the top performing REIT sector, because these tenants are large public companies able to tap the capital markets in times of distress, and that helped Vici maintain 100% of its rent that was being paid from the MGM and the Caesars. And so it's really a defensive play, while we see Vici also putting out further capital, whether through $300 recently into a mixed-use complex in Los Angeles, $500 million into a casino development on tribal land recently. And so we're seeing a burgeoning opportunity for external growth as well.
We're tight for time. I'm sorry about that. Essential Properties is your last idea. They're very diversified, but they have restaurants as part of their portfolio.
Yeah, so Essential Properties, ticker EPRT, it traffics in the net lease space. So these are, again, long-term leases averaging over 10 years on average, which gives, again, a defensive element to the stock. And it really traffics in, casual dining, some grocery, car washes, early childhood centers. And these are proving to be strong tenants, continuing to be able to pay rent. And specifically with EPRT, they have one of the best cost of capitals within the net lease sector that allows them to really go after new acquisitions. They have a strong external growth pipeline and averaging deal spreads of 250 basis points. And so we're penciling in 8% earnings AFFO growth this year, which is over twice the sector average. And that makes us really like EPRT, Essential Properties.
Jay, thank you very much indeed.
Thank you for having me on.
Jay.